Hello, welcome back. We are going to be examining a trending company and a company that's actually being asked by subscribers and viewers of the channel. That's Taiwan Semiconductor Manufacturing Company. It's a Taiwanese company, as you'll see here. And an old IPO back in 2001 was when it had its IPO days. Quite a few employees here as well, and a beta similar to the S&P 500. Now let's take a closer look at the company with our stock analysis tool, see what we can deduce out of its financials and whether it makes for a potentially interesting purchase here. Again, this kind of companies that are handling semiconductors tend to be the thing these days. A lot of people are asking about them and I totally understand. Tech company that you will see here in the max chart that it has been doing fairly well, yet recently had a little bit of a slump. It had its high and then went down to 98 as it is right now, 3% down yesterday. Now the PE ratio of the company is sitting at a 24.7. It's a bit more than we would like, but that's definitely not automatically rejecting the stock because you can pay a little bit more, go more than 20 potentially, if we're looking about a stock that grows a lot and a company that's doing well. You can actually pay a little bit of a premium if you are willing to do so. And we will examine what we should be willing to pay for the company later when we take a look at our stock evaluation tool, which is, after we do the first analysis, it kind of helps us deduce what kind of price it makes sense to pay. Now the price to free cash flow ratio is much more elevated here, and if you know me, I tend to look more at free cash flow. I think it's more important than the price to earnings ratio because this can be kind of cooked a little bit, and legally cooked, that is, with accounting tricks. The free cash flow can also be kind of cooked, but it's a little bit harder and it's easier to spot the issues. And yeah, this is a little bit elevated, and we will want to see later, we will examine the details of the financials for this one. Now the outstanding shares here have been about the same. You see a little bit of a drop here, but practically speaking it's the same. This is a rounding thing really. It's probably like a few hundred shares here, or maybe a very, very small amount, and this is why it's practically the same. It's 0.01, for instance, is what the actual number is here. But this means that these outstanding shares are basically the same, and we don't have a dilution issue here. Free cash flow to total liabilities 5.7 is borderline what I want to see, about 5 years of free cash flow required to pay all the total liabilities. So the company looks to be fine in terms of debt, really, and liabilities. Now the 5-year revenue growth keeps increasing, which is nice. Same thing with the net income growth, and you'll see a similar pattern, which I love to see. I like to see this kind of charts following through. Now this one is a little bit different, and we will examine why. The free cash flow growth and the total equity growth also increasing without the company selling outstanding shares, which means that they are making money. That's good. So the other things, the debt to equity ratio is fairly low, not much debt. We kind of already got a first hint here. And good net income margins here, very good net income margins and good return on equity, 30% is very good. So a dividend yield of 1.8%, which is actually down from what it was. So they actually had to cut down on dividends here. That's very interesting. And yeah, it makes sense because with 1.8%, they have a 45.3% dividend payout ratio, which is fair. But imagine it being here, 3.74 would mean that they were probably close to 100 here, if not more, depending on what they were doing that year in terms of net income. So yeah, this is understandable, and 1.8 I think makes a lot of sense here. That looks good. Now the PEG ratio, you can also take a look at. This is a ratio that I typically don't pay much attention to, but it's worthwhile having here. And as you'll see, a negative P ratio can be an indicator of negative earnings growth, of course, and any value lower than 1 is considered good, because this accounts for growth as well. Now the next thing that I'm going to examine here and what I want to see is the stock evaluation tool. Actually no, before that let's take a look at the financial statements. I think that should come first, because I do want to take a look at what the company is doing in terms of free cash flow and how the net income is growing and all that. So you will see here that yeah, as we have already examined, the net income has been growing, and yeah, the 5-year net income growth is significant, of course, as you'll see here. And if we take a look at the balance sheet, we already examined it from our previous stock analysis tool, and we do know that the company is not really issuing shares, so that's a nice thing to see. And so what you will see here, that the additional paid is capital, of course, it's very, very little money, because again, the company is not issuing shares. And The total equity keeps increasing as well, which is nice to see. Liabilities of the company are very fair here, 56 billion. Remember, we had the 5.7 in terms of free cash flow, which means that free cash flow will be in the region of like about 10 billion or so. So we'll see. And next up, we're gonna follow through with our cash flow statement here. And what I want to see here is, of course, we have the net income laid out here, and you will see that the net cash provided by operating activities is positive and keeps increasing. Now, there is quite some depreciation and amortization going on here for the company. That's a lot of money, and you will see that it deeply affects the actual bottom line of the operating activities cash flow, because this is 15 billion added back. Now, this is excluded from the net income, of course, because it's not a cash expense, but it is an expense, and so this is why it's added back to the cash from operating activities here. That's how it works. So bear that in mind. And the company's investing activities cash flow here is negative. That's a good thing to see, generally speaking. They're actually purchasing investments here. Sold a little bit as well. They actually sold more than they bought, so they are a net seller of equities right now, it looks like. Very close though. And capital expenditures, very hefty amount here, $30 billion in terms of capital expenditures. I guess that makes sense because of the industry. And some dividends paid, minus 10 billion in dividends. And as you'll see here, we're exactly on spot with what we projected, about 10 billion in free cash flow, because if you multiply that by 5, you get the total liabilities number, 5.7. And this also keeps increasing, but it was better last year, and it's not increasing that much unless you exclude the 2019, which was much lower. But the previous years it was 8.4, 8.22. So it looks like we're having a kind of a pattern which shows that the company is making about 8 to 9 to 10 maybe billion dollars in terms of free cash flow for the most part. So they seem to be doing well. But a company does well, we need to also know how much we should be paying for it. Because doing well is not enough for an investor. They have to be doing well, and we should be buying at a low price. That's very, very important to make money. And the revenue year-over-year growth here, the last couple of years have been better. That's because, yeah, they really increased their revenue, their sales here. That's a great thing to see from the company. They used to do 3, 5, and 3 here though. So I have to be a little bit cautious, and I think I will go a little bit low here. Let's go 4, 6, and 8, at least for our low projections. And the net income margin, as you'll see, it's about the same every year. So that's great to see. We're gonna go 30, 32, 34. The free cash flow margin, again, very similar. Another great thing to see. Solid numbers that are the same every year. I love to see these things. And 13% is what I typically want to be making out of every single stock that I own, unless it has more risk, in which case I want to make more for my annual return because I'm taking up more risk. So I hit calculate. And you'll see here that despite of the fact that the stock is actually a great company, it looks like, it's overpriced for what it is right now. And with this kind of projections, we are getting a high max price to pay today of $42, while the stock price is near 100. So it's overpriced, and you could kind of get a hint of that based on the free cash flow to price, basically the price to free cash flow ratio. And if I could try, let's just say that I'm more aggressive here and try 10, 12, and 14, which the company could achieve if they keep growing at these similar levels. I'm not sure that will happen, but it pays to at least take a little bit of a look at it. And again, we are actually much higher currently. The current price is higher than our highest projection here. So again, even though I like the company, I would probably stay away from it just because it's expensive. Wait maybe to get a discount. If it goes much lower, maybe in the region of $40, then I would be willing to buy. But otherwise, I think it's a little bit expensive as it is right now. Good company, but a bit expensive. So thank you for watching the video. I hope you enjoyed, and if you did enjoy and you liked what you saw, please leave a like, and remember to subscribe because very, very soon I will be opening up this tool and you will be gaining access if you're around. And thank you for watching this one. In the meantime, take a look at this video that I made a few days ago and discusses Carnival Cruise, an interesting cyclical company. Again, thank you for watching, and I'll see you soon. Bye-bye.